Hello and welcome back to our session on IFRS 16 compliance with Hamilton Engine by Cognitus. So today we'll be showing on how to simulate the sales and leaseback transition on IFRS 16 using our solution. My name is Zati and I am an IFRS 16 subject matter expert, part of Hamilton team in Lease accounting. So before we proceed to the simulation, we have to make sure that we understand what is a sales and leaseback is all about. Also, we need to know who's the party are and who are we doing the accounting for. Once we've done that, we will go through an example and also the accounting rules. So what is a sales and leaseback? As we know it is important for a business to take a different decision with respect to arrange the fund to run their operation and also execute the business. And sometimes it is quite natural for a business to sell the current of existing asset and take them back to lease. So according to the new accounting standard, a sales and leaseback transition are one where an entity, the seller-lessee, transfer an asset to another entity, the buyer-lessor, for consideration and lease that asset back from the buyer-lessor. A sales and leaseback transaction are a popular way for entity to secure long-term financing from substantial property, plant, and equipment assets such as land and building. And now let's jump to the example. So here we get a scenario whereby Hamilton Airlines require funds to finance a new ambitious low-cost business model. The only possible way of raising finance is through the sales and leaseback of its aircraft A350-XWB for a period of 10 years. The lease payment of $20 million per year payable at the beginning of each year. The lease commences on 1st January 2019 until 31st December 2028, with the incremental borrowing rate of 5% per year at the commencement date. So the current fair value of the aircraft is $300 million and the carrying value, which is the net book value, is $250 million. The aircraft is the performance obligation under IFRS 15 and it is sold to Cognitus Capital at the fair value. So the accounting treatment will be very depending on whether or not the transfer qualifies as a sale. And based on our previous example just now, the Hamilton Airline Company uses the asset but has sold it to Cognitus Capital Company at a fair value. So therefore, the transfer is qualified as a sale according to the guidance on satisfying a performance obligation under IFRS 15. Thus, we need to follow the new rules. For Hamilton Airline Company, which referred as a seller-lessee, need to recognize the asset. So we're going to be crediting the asset and record the sales at fair value. Since we are the lessee, we are going to recognize the lease liability at present value. We also need to recognize the right-of-use asset as a proportion of the previous carrying value of underlying asset. And also we need to recognize the gain or loss on the right transfer to the buyer, which effectively as a balancing figure. While for the Cognitus Capital Company, which referred as the buyer-lessor, they shall account for the purchase of the asset and applying the lessor accounting requirement in IFRS 16 for the lease. And if the transfer of an asset by the seller-lessee does not satisfy the requirement of IFRS 15 to be accounted for as a sale of the asset, the party need to be account for it as a financing transaction. The seller-lessee continue to recognize the asset on its balance sheet as there is no sales. The seller-lessee account for proceeds from the sales and leaseback as its financial liability in accordance with IFRS 9 financial instrument. This arrangement is similar to a loan secured over the underlying asset, in the other word, a financing transaction. So let's move on to the next slide. As you can see in the lease schedule, the present value of the annual payment, which is 10 payment of 20 million discounted at 5%, is 162,156,434. The current of fair value of the aircraft is 300 million. The net book value is 250 million and the profit from the sales is 300 million. So according to the new regulation of IFRS 16 on sales and leaseback transaction, ROU need to be recognized as a proportion of the previous carrying value of the underlying asset. And in this example, fair value is equal to the consideration for the sales. So this is calculated as the present value of the lease payment, which is 162,156,434, is divided by the fair value or the market value, which is 300 million, and multiplied by the net book value, which is 250 million. So the ROU will be recognized at value of 135,130,361. So the seller-lessee also need to recognize a portion of the total gain or loss on the sales to the extent it relates to the right retained in the underlying asset by the buyer-lessor at the end of leaseback. So the total gain on the sale of the aircraft is where fair value minus net book value is equal to 50 million. And from that total, it will be split into two portions, which is the first one is the portion relating to the right to use the aircraft retained by the seller lessee, and the second portion relating to the buyer-lessor right in underlying asset at the end of the leaseback that will be calculated as the sale value, which is 300 million minus present value lease payment 162,156,434 divided by fair value 300 million and multiplied by 50 million is equal to 22973,928. So if the adjustment are required is consideration for the sales is not at fair value and or the payment for the lease are not at the market rates, this adjustment result in a recognition of a prepayment to reflect below market terms and additional financing provided by the buyer-lessor to the seller-lessee to reflect above market terms. So now let's move on to the sales and leaseback journal entries at the treatment of the seller-lessee. So under the standard terms, since there has been a sales on our example, the asset needs to go. So we are going to derecognize the asset where debit PPE spent 250 million and credit PPE asset 200 million. And recognize the sales at fair value where debit cash 300 million and credit PPE income 300 million. And then we want to lease it back the asset from the buyer-lessor. So at the commencement date, the seller-lessee are going to debit PPE income 300 million and credit PPE expense 250 million. And record the liability at the present value where credit the lease liability 162.16 million. So the key thing in sales and leaseback is that we need to recognize the asset as the right of use asset as a proportion of the previous carrying value of underlying asset, which is debit ROU 135.13 million. And lastly, we need to work out on the gain or loss on the transfer that quite simply is just a balancing figure where credit gain or loss to 2.97 million. And without any further, let's simulate the use case in Hamilton engine and see whether the numbers are matched. So in order to create a contract in the engine, we have to load the Excel that contains all the sales and leaseback information. So we're going to use case ID LSLB. The classification and variant for this case is lease underscore NT underscore FOPS. The lease agreement is the unique header ID of the contract. Lease ID is a rental equipment, and this contract will be start on 1st January 2019 until 31st December 2028. And the payment method is advance, and it will be paid out every year. So let's continue to the pricing data. So the payment date will be the same as the contract date with a payment of 20 million per year with a discount rate of 5%. The current fair value of the aircraft is 300 million. The proceed from the sales is 300 million, and also for the net book value is 250 million. So now we are ready to load the Excel and create the contract. And now go to your SAP and run tcode/cogn/16tc underscore raw underscore Excel. Browsing your Excel file and execute with process immediately. So now the contract is created. Let's check the lease schedule by running the code /cogn/16tc_LCD. So right here, just specify your contract header ID and click on enter. This is our contract, and click on lease schedule for more details. So as you can see right here, the lease schedule is showing in contract period. But from our example, the payment will be paid out every 10 years. For better view, at the top of the screen, we can change the period by clicking this option and change the contract period and execute. So here, as you can see, at the point when the seller-lessee lease back the asset from the buyer-lessor, we are going to debit income 300 million and credit expense 250 million. And as for the rental, for 10 years is equal to 200 million that will be amortized for 20 million per year. As for the ROU asset that has been recognized as the proportion of the previous carrying value of underlying asset is 135,130,361.26, and the gain from the sales is 229,73927.75. And if we go back to our presentation slide, we see that the amounts are matched, and this is proven that the Hamilton engine is the perfect solution for this use case. I think this is the end of the session. If you haven't watched our others video on IFRS 16 use case, you can click the link on the description below. And just let us know if you have any question about it. So do subscribe to our channel, and thank you very much for watching.